This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Caught off guard, investors were reminded this week that things may not be what they seem, and you need to pay attention.
Sticker shock: why consumers on the health exchanges could be in for a big, expensive surprise.
Recipe for success: one entrepreneur's old-fashioned strategy that helped him build his business and make him millions. All that and more tonight on Nightly Business Report for Friday, May 20th.
Good evening, everyone, and welcome. Stocks finished the week on an up note, ending several consecutive weeks of declines for two of the major indexes. Today's gains were modest and largely lacked a specific catalyst, but gains they were. Here are the numbers. For the day, the Dow Jones Industrials rose 65 points to 17,500. NASDAQ jumped 57, and the S&P 500 was up 12. For the week, the Dow was the outlier, down fractionally and posting its four-week losing streak since 2014, its first one. The NASDAQ did just the opposite, snapping its own four-week losing streak and scoring the biggest weekly index gains. And the S&P 500 broke its own skid, up after 3 weeks of losses. All in all, it was an eventful week, chock-a-block with reminders for investors as we turn towards summer.
Reminder number one: the Fed matters, and it may raise interest rates this summer. The minutes from the April meeting released Wednesday all but said so. Not a promise, but lots of hints. And it wasn't just hints in the minutes, it was Fed speak. Listen to Bill Dudley of the New York Fed.
The economy looks like it's growing above trend, and inflation stabilizing, labor market's tightening.
All that chatter caused Fed fund futures, used by investors to bet on central bank policy, to spike. They now price in a 30% chance of a rate hike in June, up from just 4% last week. Reminder number two: consumers are spending, but spending selectively. Cars are hot, so are home improvement outlays. Discounters are doing okay. Even Walmart is humming for a change. But roaring is what Amazon and other online retailers are doing. And that spells trouble for old-line department stores like Macy's and Nordstrom. Their numbers were shabby, not chic.
We certainly are going to see half of the business go online over the next 13, 14 years. If I'm right about that, and it's going to go up from the 7.5% to 10% penetration now, there's going to be a lot of stores have to go away.
One thing that isn't going away, we found this week, is the presidential race. That's reminder number three. And it's a tightening race, by the way, one that will surely hang over the markets between now and November. Trump is a presump. So is Hillary. But she hasn't closed the deal just yet. And two polls this week show Trump leading Clinton among likely voters in November. He's closing the gap in two other surveys. Investors, get ready for an interesting summer.
Rod Smith joins us now to talk more about the markets. He is Chief Investment Strategist at Riverfront Investments. Good to see you again, Rod. Welcome back.
Yes, Sue. Thank you. Nice to be here.
Let's start, first of all, with reminder number one, which is the Fed, the Federal Reserve. As Tyler pointed out in that piece, the Fed matters. What did you glean from the minutes this week about what we should expect from the Fed?
I gleaned two things. The first one is that they are acknowledging, which I think is fair, that the U.S. economy continues to chug along, continues to create jobs. The second thing they're acknowledging is that if they are going to do anything this year, it needs to be in June. September's way too close to the elections. But I think that the third thing is, and this is where the markets got it wrong, is, I would say the Fed themselves doesn't know what they're going to do in June. The Fed truly is data dependent, but not just U.S. data dependent. They're globally data dependent. And I think they have come to a very important understanding with China, which is, after all, a currency pegged to the dollar, that in the absence of an improving China economy, while you might get one rate hike, which I think is unlikely, you're not going to get significant rate hikes.
Can I make money in the stock market this summer? And if so, how and where?
Yes, you can, Tyler. Not only you, but all your viewers, I believe. But you have to be realistic about your expectations if you're looking at the U.S. stock market especially, and if you're looking at, the overall averages. Because earnings growth is not going to be that strong, and as you guys mentioned, it's an election year. But as long as the economy continues to grind higher, the stock market's going to do the same. Interestingly, though, we've got a new bull market emerging in something that's been in a bear market for 2 years, and that's energy and material stocks. And that's where I'd be putting money at the margin to make money.
Rod, as we look at what's going on in the economy, though, we're also seeing some very interesting shifts. The consumer spending, but not spending in the same places, and retail really struggling. Where do you see strength in the economy? And is it enough strength to keep the economy and the markets moving forward?
Well, I think here we are, 3 baby boomers talking about the new economy, but my guess is that your home is the same as mine, and that the FedEx or UPS person turns up now 3 days a week, whereas 5 years ago they barely showed up at all. So I think we've all moved into this digital world that your earlier guest was talking about. That is not going to change. I think retail always has dynamics and challenges. That's a big one. As far as the overall economy, people keep predicting its demise, but there's something wonderful about a slow and steady economy, and that is, absent a big shock, it just keeps chugging along.
How did you know the FedEx guy shows up at the house all the time with packages? How did you know that? Right you are. Rod, we'll leave it there. Thank you so much. Rod Smith with Riverfront Investments.
So what exactly will it take for the Federal Reserve to raise interest rates this summer? Central bankers may say one thing, the markets another when it comes to one important part of the economy. Steve Leisman explains why.
Investors were caught by surprise this week by increasing talk from the Fed of a possible June rate hike. One reason for the surprise? The April jobs report had been weak and wouldn't seem to be enough to justify a hike. But the Fed, they had a different take. Payroll gains of 160,000 were just fine for them. That's because Fed officials appear to have a lower standard for job growth than the markets. For the markets, 200,000 has become the mark of a healthy payroll report. For the Fed, it may be as low as half of that.
The kind of growth that we'd be expecting would be 80 to 100,000 jobs per month. So while 160,000 is not as good as what we were seeing in the first 3 months of the year, it is probably good enough to continue to get labor markets to tighten up a little bit more, to get a little bit closer to my own view of full employment.
What the Fed looks at is the level of job growth needed to take care of the increase in the workforce. In other words, what keeps the unemployment rate roughly unchanged around 5% or lowers it just a bit? With immigration down and baby boomers retiring, the economy needs less job growth than it used to. Fed Chair Janet Yellen has put the number at just around 100,000 jobs per month. San Francisco Fed President John Williams says it's as low as 80,000. All of that raises the question, what happens when the May jobs report comes out 2 weeks from now? The market could be disappointed, but the Fed, with its lower standard, could still hike.
If we get a 150,000 number, for example, the market may view that as a disappointment, whereas I think many in the Fed would view that as well in excess of what is sustainable on a long-run basis. So I think right now there is a gap between what the market and the Fed think are good jobs numbers.
The best bet for investors, hope for a lot of job growth because that's good for profits and it's good for the economy. But be prepared. What's disappointing for markets could be just fine for a Fed that has lower standards. For Nightly Business Report, I'm Steve Leisman.
And now to housing. Sales of existing homes rose 1.7% in April. That was the second straight month of increases. The growth was driven mostly by the Midwest, which is the region considered the most affordable.
It appears that a bank in Ecuador was the victim of a cyber attack similar to ones that hit Bangladesh and Vietnam. As first reported by the Wall Street Journal, the heist ended with thieves transferring $12 million to accounts around the world. The discovery comes 1 week after SWIFT, the global bank system that was breached, told its clients to secure their local computer networks.
But it's not just the global banking network that's vulnerable. Your bank account is as well. There's new malware that infects your computer and then sits like a serpent waiting to strike. And as Andrea Day reports, you can't just rely on your bank's internet security measures anymore.
You are a target all the time.
When one of the top security advisors at IBM has a warning, you might want to listen.
When we first saw it, we're looking at it, we're seeing something bad is happening here, but we've never seen this before.
It's called Goznim. Etai Mayor and his team in Israel discovered the new malware. He says it's already hit banks in the U.S., Canada, and Europe.
It's very hard for antiviruses and other software to actually detect it.
That's because he says Goznim is a highly sophisticated combination of two different tools: financial malware that infects your computer and a tool that secretly waits to steal your information.
It stays dormant on your computer until you go into a financial website of interest, and only then it pops up and starts stealing data.
Like your username and password from bank accounts and more.
The criminal is sitting on the other end and obtaining that information in real time and using it to log on to your account.
How much do we think could be at risk?
We already know of $4 million that were stolen by this malware. The potential is much bigger.
The hackers behind it even leaving top researchers bewildered.
We are up against professionals, and we believe they're located somewhere in Eastern Europe.
According to Mayor, the malware typically gets in through an email, sending you a link, and clicking that link will infect your computer.
It may seem obvious, but don't click on the link. Make sure your operating system is up to date and don't use the same password for every account. And those paper statements you used to get in the mail, well, they may not be such a bad idea after all. Mayor says the malware can actually change what you're seeing on the screen. So if they steal money, they can make it look like the cash is still there.
We reached out to the American Bankers Association, and they tell us that financial institutions have tools to stop Goznim and authenticate customers, but that cybersecurity is a shared responsibility between consumers and banks. We also contacted the Financial Services Information Sharing and Analysis Center, a group set up by the industry to share threat information. They say U.S. banking trojans and malware attacks, quote, continue to be a concern that the financial services industry takes very seriously. And we've alerted our nearly 7,000 institutions to these types of threats.
And how serious is this? Well, according to Mayor, just last year, 20 million financial records were stolen by malware. As for what's being done, according to the experts, banks are working to reduce vulnerabilities. And the FBI tells us it will continue to combat cybercrimes. I'm Andrea Day for Nightly Business Report.
Coming up, shopping for stocks. The Picks One portfolio manager says we'll grow 20% within a year.
Something curious happened today at Chicago's O'Hare Airport. When the head of the TSA arrived, the security lines were miraculously shorter. Much shorter than the long ones that have plagued that airport all week. Today, the head of the agency, along with Illinois Senator Dick Durbin and Chicago Mayor Rahm Emanuel, promised shorter wait times.
We had a breakdown here in Chicago, and that was unacceptable. The long lines and the wait times caused quite a few people to miss their flights. As I said earlier this week at a previous talk, I am very sorry to those people that did that, and we are working hard to make sure that doesn't happen again.
The TSA administrator also acknowledged that this summer will be challenging. Companies are sitting on a lot of cash, and 1/3 of it is owned by just 5 U.S. companies. According to Moody's, Apple, Microsoft, Google's parent company Alphabet, and Cisco and Oracle have more than $500 billion in cash and cash equivalents. Cash holdings are becoming even more concentrated as well. In 2013, those same 5 companies held 25% of the total.
Key part of the Affordable Care Act may slowly be going away. Bronze plans, which tend to have the lowest premiums of all the tiers, also incur the biggest losses for insurers. So what's going to happen? Some of those insurers don't want to carry them anymore. And as Bertha Coombs reports, that could have broader implications for those who get their health insurance on the exchanges.
Judging from initial 2017 rate requests, customers on Affordable Care Act health exchanges could be in for major sticker shock next fall and fewer lower cost options. Insurers are asking for sharp price increases after seeing big losses on exchanges the last 2 years. In Washington state, the average increase request is 13.5%. In Oregon, the 2 biggest insurers want 30% increases. In New York, on average, it's 17%. 20%, and in Virginia, 23%. Leerink analyst Anna Gupta says insurers are being more cautious for 2017 because some ACA reinsurance provisions to backstop losses will expire.
The health risk on exchange has not been very good. There has been a lot of adverse selection. Some of the sickest members are buying insurance, if you will, on the way to the hospital, and after paying premiums only for 1 to 3 months, they then disenroll off of the exchanges, and that creates very heavy pressure and losses.
For many insurers, the biggest losses have come with the lowest cost bronze tier. A unit of Virginia's CareFirst Blue Cross said in its 2017 filing that it will stop selling bronze plans, which means that those customers would face a 70% increase next year because they'll have to shift to silver plans. The problem is that lower cost bronze plans tend to see more turnover, according to fund manager Les Funtlater.
You have the unhealthy people signing up when they need something and then hopping off when they don't. And so what you have is a bad case of adverse selection, which means that you're only insuring basically the sick.
But opting out of bronze plans also carries risks. Nonprofit co-op insurer New Mexico Health Connections is asking for a 30% increase overall, and its CEO told me they're considering opting out of bronze plans, but he worries that will only drive away more young, healthy enrollees. Insurers have until late summer to submit their final plan offerings, and one insurance regulator cautions there will be a lot more discussion with plans in the next few months. For Nightly Business Report, I'm Bertha Coombs.
Deere cuts its yearly earnings forecast for the second time this year, and that is where we begin tonight's market focus. Despite posting a drop in both revenue and profit, the maker of farm tractors did manage to beat estimates. But the company's CEO said results were hurt by the global farming recession and weakness in the construction equipment sector. As a result, the company lowered its profit guidance for the full year, but it expects sales to fall less than previously estimated. Shares fell 5.5%, 77.74. Foot Locker saw its quarterly revenue and profit climb, but the results were mixed. Profit fell in line with estimates, while sales failed to meet targets. The shoe retailer also reported worse than expected same-store sales growth and cited lower demand in its basketball shoe category. Foot Locker sales fell more than 6% to $54.77. And Campbell's Soup posted revenue that missed street estimates, thanks in part to a weak soup season in the U.S., challenges in its V8 beverages, and a weather-related disruption to its carrot supply. Those were the problems there. The carrots were the problem. Profit did rise, however, and came in above targets. Campbell's also raised its earnings outlook for the year. It's looking better for carrots. Shares fell more than 6% to $59.90.
Oil and gas producer Oil Search will buy rival Interoil in a deal valued at more than $2 billion. French energy company Total will also help fund that acquisition. Together, the companies will create a gas field in Papua New Guinea to take advantage of that country's low costs. Shares of Interoil gushed 37% higher to $43.57. Oil Search trades in Australia. And Yahoo could get much less for its core business than it was hoping. The Wall Street Journal says bids are expected to come in the $2 to $3 billion range. Analysts had forecast between $5 and $8 billion. Shares fell more than 1% to $36.50.
And now to our market monitor, who has a list of stocks he says will rise at least 20% in less than a year. It's first time joining us on the program, Michael Yoshikami, founder and CEO of Destination Wealth Management. I don't know whether it's the first time you've been on the program. It's the first time maybe you've been in the market monitor hot seat. Let's turn up the heat, Michael. Disney's your first pick. Why do you like it?
I like Disney. Good management, great brand, great digital content that is going to play around the world. It's a company that's 15% off its 52-week high, and we think that the recent earning miss was really more of an anomaly than anything else. Disney has many great things going for it. I think it's a great company.
Costco, a place that I end up going to an awful lot, is also on your list.
You go to Disney, too.
I go to Disney as well. That's right. I'm all over the place.
So, yeah, well, I thought you were home waiting for your FedEx package.
I usually am,
Costco,
too.
So Costco is going to be the beneficiary of that dislocation you're hearing so much about in retail. The earnings problems we're seeing for the retailers, the Nordstrom's numbers. Yes, Amazon's going to continue to grow, but there's always going to be a place for brick and mortar. I think Costco has a reasonable strategy to expand on a more methodical basis. Great management, great brand, and incredible customer loyalty.
And number 3 is Vodafone. Tell me the narrative behind it.
So Vodafone really is all about the wireless space and the increasing traction in places like India and China, emerging markets. I know emerging markets is a scary word for folks. This is not an emerging market stock. This is a stock that pays a healthy dividend that's going to give you the opportunity to participate in the wireless growth that's happening in countries such as India. That's why Tim Cook is there right now from Apple. That's why Vodafone, I think, is going to have a huge presence in these developing markets.
Michael, let's broaden it out a little bit. How do you feel about the market overall? What kind of a year do you think we're going to have?
You know, I think when it's all said and done, our view for the year is that it's probably from January 1st to December 31, probably a 5 to 7% year, which means it's got a ways to go since it's basically at a 6-week low right now. You know, I think that the economy is not great, but it's not as bad as everyone is saying. I think that the Federal Reserve probably will raise interest rates maybe 0.25%. I'd be shocked if they went 0.5%. If they only go 0.25%, we're still talking about incredibly low-cost financing for companies as well as individuals. We have oil companies starting to rebound a bit. So I think the outlook for equities is cautiously optimistic. I'm not one of these doom and gloom folks like you hear on the radio where the whole world is going to collapse in the next 3 months. I just don't see it.
Let's hope it doesn't. Michael Yoshikami, thank you very much. Great as always to see you. Michael is with Destination Wealth Management.
Coming up, sizzling success, how one entrepreneur's strategy to keep things simple helped him win over finicky customers and helped him make his millions. Here's a look at what to watch for next week. On Tuesday, we get more information on the spring selling season when new home sales are out. On Thursday, the FDA is due to decide whether to approve a controversial muscular dystrophy drug made by Sarepta Therapeutics. And on Friday, Fed Chair Janet Yellen is scheduled to appear at a panel hosted by Harvard University. That's what to watch for next week.
So how do you make millions in an industry where 60% of new businesses fail within the first year? For one restaurant chain founder, the answer was literally location, location, location. He had to close 3 of his first steakhouse joints because of poor placement. And since then, he has personally and methodically scouted every single spot. Nearly 500 locations and more than $1 billion in sales later, he's figured out how to beef up business. His story in tonight's How I Made My Millions.
Hearty steaks, killer ribs, ice-cold beer. It's a winning formula for Texas Roadhouse, the lively restaurant chain with $1.9 billion in annual sales that's been serving up food and fun for more than 20 years.
Hello, how would you like your sirloin steak cooked?
And the man who created it all from scratch is Kent Taylor.
How y'all doing?
Whose introduction to the food industry happened 40 years ago in his hometown of Louisville, Kentucky.
That's looking good. I started working in the restaurant business in high school as a busboy, so a long time, since I was 18.
Taylor worked his way up to a waiter, a bartender, and eventually held management positions at chains like TGI Fridays, Bennigan's, and KFC.
I learned that food quality matters. In the early days, I won't say which concepts I worked for, but the food maybe wasn't so good.
So he began cooking up plans for his own place. He sketched out early ideas, where else? On a cocktail napkin in 1992, and then went looking for investors.
There's a story that you approached some big investors like John Y. Brown at KFC.
Absolutely.
And what did he tell you?
No. I would say all told, I got turned down over 100 times. I ended up getting 3 doctors to start me out at Texas Roadhouse.
In February 1993, Taylor opened the first Texas Roadhouse in Clarksville, Indiana, with others following soon after. By the end of its first year, Texas Roadhouse had served more than 250,000 guests.
I like about a 6-second read from an interstate or a main drag.
6-second read, meaning you can see the establishment for 6 seconds. On a scouting trip in Newburgh, New York, Taylor looks for a location with just the right ingredients for success.
A medium-sized city that has a university, a military base. We're on the interstate, and all the stores that we would compete with are doing above their national average.
Who gives you the best information?
Bartenders.
Bartenders will tell you whether the location is doing well or not.
Typically, yeah. You give them a big tip. You know, no telling what comes out of their mouth.
On average, each Texas Roadhouse feeds between 5,000 and 6,000 customers a week, with an average ticket price of more than $15. That places the restaurant price-wise right in between Applebee's and Outback Steakhouse. What are the details that make you different, better, more successful?
I would say that number one thing is we cut our own meat in-house. We make our dressings from scratch. We even grate our own cheese.
Bringing that simple concept to customers around the world has been Taylor's life's work. 50,000 employees work at 485 restaurants worldwide, and Taylor has no plans to slow down.
I think we can do 700 plus in the States, and internationally, who knows?
Interestingly, Taylor doesn't advertise the success of his restaurant chain. In fact, he doesn't advertise much at all. He prefers that his managers do their marketing within their own home communities, which allows him to spend more money on food quality and zero on a national advertising campaign.
What a character.
Don't expect to see him advertising on the Super Bowl.
No, I don't think so, but he doesn't need to at this point.
Really careful. He goes for mid-sized towns, off the beaten path, not in the major metros.
Wow, that's fantastic. All right, have a great weekend. That's Nightly Business Report for tonight. I'm Sue Herrera.
And I'm Tyler Matheson. Have a great weekend, everybody. See you Monday.